Hello everyone. Today we'll be discussing about investing in individual stocks versus ETFs. What is better for whom? Why we should invest in ETFs? So we'll look at some parameters why we should invest in ETFs. So first of all, it provides diversification. So if you buy an individual stock, it is just one stock versus if you buy an ETF, then the ETF contains 30 to 50 stocks depending on which index it tracks. Lower fees. So generally the expense ratio of an ETF is usually 0.03 to 0.5%, at max 1% in certain cases. It is easy to buy and sell. Just like regular stocks, you can buy and sell them during market hours. It provides sector coverage. For each and every sector, we have an ETF mostly. It is like a passive income. So basically, all the dividend distributions will happen with minimal management. You don't have to actively check the dividends and all that. Reduced risk because basically you are buying a lot of companies in one fund, right? So your concentration is pretty less in one particular stock. So that way it is lower risk and medium returns, nothing like great extraordinary returns. Okay. So why we should invest where? Who should invest where rather? Okay, so when we talk about individual stocks, they are more suited to experienced investors who can track the market, who can track the individual stocks. Those people have time to research the companies in detail. Some great HNI investors or even big investors, they even have connect with the management, they talk to the management, and then they take the positions in those kind of individual stocks. There is a high risk tolerance that is required to buy individual stocks because if there is a negative news in one particular stock and it falls 20%, then your individual stock that you are holding can go down 20%, right? So that is a high risk. Interested in specific sectors. So if you are interested in some sectors, then you can go for an individual stock. You can pick out the best stock out of that particular basket of stocks in that particular sector. It is more suited to active traders because they can keep track of the news, of the technicals and the fundamentals of the stock regularly. Okay, and if you have a long-term conviction, you can hold on to individual stocks. Now, when we talk about ETFs, it is more suited to beginners to intermediate investors, but it can also help the other investors who want to hold it for a longer term without doing a lot of research. Because individual stocks, you have to research a lot. What is the company doing? What is the moat of the company? Does it have any negative news, positive news? Those kind of stuff you have to track. But with ETFs, because it is a basket of stocks, you don't have to worry about it. Right? Because it is in a particular index that it tracks, it will be bought in the ETF as well. That particular, basically the whole sector will be having like 20-30 stocks. All those stocks would be bought in one ETF, right? Lower risk. So basically, if one stock goes down out of the 50 stocks that the ETF holds, then the risk is pretty less, like 0.5% to 1% at max, depending on the market cap. You get instant diversification without worrying about it. Let us say you buy a Nifty ETF. It contains 50 stocks, right? So you are pretty much diversified immediately. You do not have to buy individual 50 stocks. Everything will be there in the Nifty ETF. Okay. The investors who just want to stay passive, who don't want to actively manage their funds, they can just get into the ETF and get out at the appropriate times. And you can build long-term wealth with ETFs without worrying about the short-term volatility. Okay, when we talk about risk management and position sizing, so maximum position size you can take in a particular stock is 5 to 10%. Mostly it should be 5%, not more than that. But in exceptional cases, you can have it until 10%, but not more, because if that stock fails, it can mess up your entire portfolio. Versus ETF, you can even go from 10% to all the way to 100%. Okay. And then you can even diversify your ETFs. Like one ETF would be for large cap, one for small cap, one for mid cap. You can also diversify across asset classes like gold, silver, so precious metals ETF. Then you can have bond ETF or government securities ETF, right? So that is your safe basket. For growth, you can use the equity ETF, right? So that way you can have multiple ETFs in your account, which will diversify across sectors, across asset classes. Okay. The risk is very high in individual stocks, and with ETFs, it is pretty much very low and minimal. This is a side-by-side comparison. So risk level is high in individual stocks versus ETF, where it is very low risk. Diversification, there is no diversification in individual stock, but with ETF, it is greatly diversified. Time required to buy a stock or research a stock, it is huge. You have to do a lot of research, whether technical, fundamental, whatever you track, you have to do that research and constantly monitor that. Okay. And then with ETF, you don't have to research the all the individual stocks. Rather, if it is a sector specific ETF, just check how is the sector doing overall, what is the future for this particular sector, right? Or if you are tracking Nifty, then you can have a Nifty ETF, right? So Nifty ETF will go along with Nifty. If Nifty gives you 1% return, ETF will give you 1% return. Versus individual stocks, it can just vary depending on that stock, right? Flexibility, you have great flexibility in both, because both can be actively traded. You can buy and sell those ETFs or individual stocks at any time of the day when the market is open. Okay, dividend income, it is pretty much the same across both. So in individual stocks, it depends on that particular stock, whatever they announce. But in ETFs, it is a basket of stocks. So overall, you would get consistent returns, like maybe 3 to 5% at max. Okay. But individual stocks, you can have like 10% dividend in some stocks. In some, you can have zero dividend. If the company does not perform well, then the dividend income will be less, right? Sometimes the dividend will not be announced. That kind of stuff can happen. But when you have a diversified portfolio with an ETF, then you do not have to worry about one individual company, how much dividend they are announcing. Rather, just assume that 3 to 5% dividend yield will be there by default. If some companies announce more, some will announce less, some will not announce dividends. In that case, you can still get a consistent, range of dividend, like 3 to 5%, 5 to 7%, something in that range. Individual stocks, the individual investors, the beginners, the intermediates, and the experts, everybody buys stocks, but it is not suited to beginners because of the risk, because of the research that is required, because of the time that is required. There is no diversification, right? So it is not very suited to beginners. But ETFs, everybody can buy it. Even the active investors can buy the ETFs, right? If they want to deploy huge sums of money, they cannot put it in one particular stock. Rather, they would just buy a bigger ETF which tracks multiple different sectors, like a Nifty, right? So it has all the sectors in Nifty, correct? So that is why ETFs are more preferable for everybody. These are our key takeaways. So ETFs offer instant diversification, as we discussed. Position sizing, it matters a lot because you can allocate up to 100% in an ETF. If you are, if the ETF is well diversified like Nifty, it has stocks from all the sectors. then you can even just hold one ETF. That should be okay. But if you want to diversify, you can have multiple ETFs. And when you buy a single stock, it is not at all diversified. Lower cost and fees. So typical expense ratios are 0.03 to 1% annually versus individual stocks. So basically, if you buy and sell, then there would be some stock brokerage, right, that will be involved. So based on that, ETFs are a better play. Choose based on expertise and time. So if you're expert at stock picking and if you can research a stock well, nothing like it, you can be an active stock trader or an investor where you can keep a track of individual stocks. But if you do not have the expertise and the time, then better to go with the ETFs. Both have a place. Some people are more suited for stocks, some are more suited for ETFs. It depends on your expertise and conviction and your dedication to the market and to your own portfolio. Okay, so with that we come to the end of the presentation. Now let me walk you through a few ETFs. Now let us look at some famous ETFs across different sectors. Okay, so these are the Nifty ETFs. So they will track Nifty directly. So if Nifty goes up 1%, this ETF will also go more or less up 1%. Okay, so basically it tracks the Nifty. And this is banking and finance. So there are some ETFs which are more specific to the bank Bs. Banking, Bank Nifty. There are some who track the finance sector. Okay, so it is like CNX Finance. We have a particular index for that. So some will track that one as well. When we talk about momentum, so basically there are some momentum ETFs which will be across different capitalization like large cap, mid cap, small cap. There are some ETFs which will provide you more returns than the underlying index. So let us say alpha. So alpha will be like giving you more returns than the Nifty. Okay, momentum will give you more returns than the Nifty, but these ETFs, they will fall more than the underlying index. Okay, because they generate an alpha, they are more volatile. Okay, talking about gold, we have a bunch of gold ETFs. Silver also we have a bunch of them. Metals, bonds and government securities. Mid cap ETFs, small cap, IT. Then we have realty, defense, tourism, healthcare, service, which caters to the service sector. This is auto sector, infra sector. This is public sector enterprise, power and energy, and FMCG. So you have pretty much exposure to each and every sector through the ETFs. So depending on your conviction in a particular sector or a particular asset class like bonds or gold and silver, you can choose whichever ETF you like. You can have a bunch of them, have some Nifty ETFs, have some gold, silver, bonds. That way you are pretty much diversified across different asset classes. Okay, if you want to have more if you are looking to have some more returns and if you think the market is good, then probably small cap is the one. If it has corrected a lot recently, then small cap would run fast pretty quickly if the valuations are pretty much decent. Okay, so that is what you can do with the ETFs. So if you like this video, do press the like button and subscribe to my channel for more such videos. Also do share it with your friends and family so that they also learn about ETF investing and individual stock investing. Thank you.